Well, the AI optimism lifting those stocks, also helping the major averages finish October, which has been a volatile month, with gains. The NASDAQ 100 up nearly 5%, longest monthly win streak since January 2018. S&P 500 is up more than 2% month to date, longest monthly win streak since August of 2021, led by tech, healthcare, discretionary, and utilities. Names like AMD, Micron, Teradyne, and JB Hunt are leading the index higher. So, is it smooth sailing to the end of the year, or are there hiccups ahead? Let's bring in Unlimited CEO and CIO Bob Elliott. Friday, Bob. How are you feeling about these markets? The investors don't seem to want to let everything go down for too long.
They certainly don't, and I think part of what we're seeing, to connect it to the Fed earlier in the week, is that the Fed is cutting interest rates, and there is more liquidity in the system, and typically you'd get a macroeconomic response from the real economy, but there's so little demand to borrow that basically all that liquidity that's coming from the Fed and global central banks running easy money is being channeled into asset prices and basically moving from one mania to another when it comes to the financial markets. And so that's largely where we're seeing all that easing play out, is in financial asset prices.
Now, you say the AI hyperscalers haven't shown an indication they can generate revenues from the real economy commensurate with the CapEx boom. But, I mean, if they could, then it would be too late to be spending on CapEx, right? I mean, don't they have to look at the best signal they have and the best historical sense they have of what's coming and build ahead of that, or risk getting left behind?
Well, I think a lot of these folks are basically taking the most rational choice that they possibly can, which is to even be in the game, you've got to build the infrastructure. And so I understand why they're doing what they're doing. Each individual agent, it almost seems clear that's the only path. The challenge is that the environment might well be a winner-take-all environment. And let's be realistic, that winner-take-all, while we're all focused on the U.S. markets, it may be in the U.S. or it may be somewhere else, for instance, from China, when it comes to these AI models. And so the real question is not whether or not they're acting rationally. I think the question is basically, what is the likely ROI in all of this CapEx? And as a group, does it make any sense, right? If everyone is jockeying to be the front runner and the winner, then almost inevitably there's going to be a lot of this CapEx that doesn't make a whole heck of a lot of sense.
In a way, though, are the hyperscalers, the big tech companies, more protected themselves from that potential downside versus some of the folks who are taking the overage from them? Maybe the core weaves, maybe the equipment makers who they're buying from now but might slow down their spending on later. I mean, these are big companies with outside businesses, not just based on what they're doing specifically with AI right now. They could stay warm during winter, right?
Yeah, well, certainly these businesses, Google, Amazon, Meta, they all have core businesses, which, to be frank, are the way in which they're financing all of this AI spend. The challenge is basically what's happened is they've channeled all of their free cash flow, something like 60, 70% of the free cash flow right now, and moving towards basically all of their free cash flow into a huge AI bet. And what that highlights is that there's a real risk that they don't get the return on investment from the spending that they're doing. And so that's really the question, not, Google, Amazon, Meta, et cetera. These companies are going to be around for a long time. The question is, would they be better off, distributing that capital to shareholders or investing in all this infrastructure that may or may not be useful? And then on top of it, are investors themselves into those stocks really pricing in the right probabilities that they'll get a payoff? Look,
okay,
the free cash flow yields on these companies are very low at this point.
Well, that is the question then. Well, we're talking about an AI data center version of the warehouse build-out that Amazon did during COVID that they then had to digest and recover from. Won't the whole market potentially suffer if that ends up being the case with AI? And as an investor, how do you strategize around that?
Well, I think as an investor, you basically have to use this opportunity, this mania, to take some profits here. There's no reason to go all in on this trade, given the overall picture is not looking particularly compelling from an ROI perspective across the whole sector. So, use these rallies to take some money off the table, create a little more diversification in your equity portfolio. And,
that's what you said about gold a couple of weeks ago, Bob, and that was a very prescient call based on what gold has done since it was at 4,300 or so.
Yeah, that's right. I mean, look, one of the things you learn if you've been in this business long enough is don't be greedy. And in the world of the financial markets and in a world of sort of speculative manias popping up everywhere, if you're a long-term investor, you're going to win because you probably have some bets on the table in those various areas. But the way you're going to win is by not leveraging into the mania, but by taking your luck and taking your chips off the table when you're deeply in the money.